Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
Year-end tax planning is usually like watching your favorite old Western one more time. You know it's going to end with the good guys riding off into the sunset. This year, however, the movie is a real thriller, and no one knows how it's going to end on December 31st. Politics, North Korea, or the bad hurricane season could derail sweeping reforms of the U.S. tax code or conspire against giving individuals or businesses any tax breaks. No one knows if tax laws are going to change, much less how the stakes are high. For instance, the Trump administration wants to eliminate the estate tax. However, at the time when millions of Americans in Texas and Louisiana are struggling from the effects of Hurricane Harvey, and almost the entire state of Florida is repairing damage caused by Hurricane Irma, lowering taxes on the wealthy may not be politically untenable. In August 2005, destruction brought by Hurricane Katrina in New Orleans was a key factor in squashing legislation to eliminate the estate tax. The weather, along with the U.S. Gulf and Atlantic coast, could influence lawmakers enormously until the hurricane season officially ends November 30th. Legislation on estate taxes is as changeable as the weather until December. Planning for one proposed change could protect your family from an unexpectedly bad tax outcome on an inherited IRA account. This proposal has received bipartisan support and could be included in any final law. Because it's enacted can be costly to families with large IRAs, it's worth knowing the basics. Under the current rules, non-spousal heirs to an IRA can take distributions over the course of their lifetime, allowing children to stretch withdrawals over many, many years, and the assets grow tax-deferred or tax-free possibly for decades. Under the proposed changes, your heirs would be permitted to withdraw only $450,000 based upon their age and life expectancy, and the rest would be required to be withdrawn and taxed annually over only 5 years. Any parent with more than $500,000 in an IRA who has named their children as beneficiaries would be affected by this change if it is enacted and will require careful planning to mitigate this effect. Income tax rates are expected to come down in any tax bill that is enacted. For a married couple in the top income tax bracket of 39.6 and an income of $500,000 a year, that's about $25,000 in reduced taxes. That's a lot of money likely to find its way into the economy. The Trump administration has promised to release a detailed tax reform plan by the end of September, but attempts at sweeping reform of the tax code have not been successful since the 80s. It's far from certain that a major overhaul will pass by the end of 2017. Despite the uncertainty, the stakes make it important to be prepared for what's ahead. Although doubts about tax cuts have grown all year, stock prices have risen steadily due to a strong economic fundamentals. The Dow Jones Industrial and Standard & Poor's 500 have repeatedly broken their records highs this year, despite domestic political uncertainty, natural disasters, and the North Korea nuclear threat. A crisis could suddenly shift our sentiment and drag a 15% stock price plunge, but no economic benchmarks are weak. With no recession-inspired bear market on the horizon, stock prices could be driven higher as the cycle rolls along. We are financial professionals. We are an independent and authoritative source of analysis about managing your money. To receive updates on year-end tax tactics, Please subscribe to our e-newsletter.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.